It's been a few weeks since Alibaba reported their earnings, and I wanted to go over that announcement and my opinion on some of their numbers. So if you enjoy the video, drop a like down below, and if you want to see more videos like this one, make sure to subscribe. Before we jump into all of those numbers, I wanted to comment on this article that I saw on Google about whether Alibaba or Peloton was a better buy. And to me, it's absolutely insane that Peloton is being mentioned in the same article as Alibaba. For one, the two businesses are completely different. The second thing is the fact that Peloton is not a good company at all. They went through a hype cycle in 2021 where their stock price shot up to massive highs that were very unprecedented and not justified behind the fundamentals of the company. And we can see that from there, the stock is down over 97%. If you look at Peloton's top line numbers, they aren't as terrible as you might expect. They saw a huge amount of growth over the early years of the pandemic. However, when everything reopened, their revenue began to fall. They've done a good job of actually sustaining some higher revenue, and they haven't fallen all the way back down to the levels they were seeing in 2019, which overall is a positive, but their EPS shows a different story. And when we look at Peloton's EPS numbers, we can see that in the middle of 2020, they had one very amazing quarter where they put up $1.37 of positive EPS. However, since then, they have had a negative $3.86 quarter, which has resulted in a trailing 12-month EPS of negative $8.77. One positive for Peloton is it does look like they're getting closer to profitability. Over the last few quarters, they have only put up negative around 50 cents of EPS. However, they still have a long ways to go before the business flips to being profitable. So personally, when I see articles like this that are comparing Alibaba to a company like Peloton, I actually see it as overall a positive thing, because what it tells me is that investors right now want nothing to do with Alibaba and Chinese companies. They're putting it in a basket with unprofitable stocks and stocks that you would never want to touch, right? Peloton is down over 97%. There are no investors looking at this company. And the fact that Alibaba is in a similar boat tells me that if Alibaba comes out with even decent numbers, that we could start seeing a flood of investors into the company. Overall, the earnings that Alibaba reported on February 7th are not going to move the needle in the right direction for the company. They didn't come in with amazing numbers. One thing I wanted to point out on Google is that they just get it wrong all the time. I would always go to Alibaba's website to actually see their earnings and what they reported, because here on Google, their expected EPS is in Chinese yen. And for some reason, it always takes them a while to convert this over if they ever even do. Sometimes they will, sometimes they won't. You can see these misses that are reported down here. That's because the reported is actually in US dollars. So it looks like they missed their earnings by 90%. That's not accurate. We'll look at their actual numbers here in a second. And then revenue is in Chinese yen, and they missed slightly. They reported 260.35 billion Chinese yen versus an expected 261.72 billion Chinese yen, which was about a 0.5% miss. And Yahoo Finance gets a little bit closer, but they are still wrong with the numbers that they have reported here. They have an actual EPS of $2.64 versus an estimated of $2.67. So when you go on Alibaba's website and look for their earnings report, you can find the section on the first page about their EPS. And the number we're looking at is non-GAAP diluted earnings per ADS. And they came out with $2.67. So just in line with what analysts were expecting. And for their GAAP earnings or their diluted earnings per ADS, they put up 80 cents. So overall, non-GAAP EPS grew about 2% year over year, and revenue only grew by about 5% year over year to 36.7 billion US dollars. So keep in mind with these numbers that the Chinese economy over the course of the last year has been in the worst position that it has been over the last 10 to 20 years. And what that means is Alibaba, despite all of this, is basically staying flat to even slightly growing their top line numbers. So overall, I see that as kind of a positive thing, that if the Chinese economy is as bad as people are saying and Alibaba is still able to grow their numbers, that overall is good in my opinion. And part of the reason that their GAAP EPS was only 80 cents has to do with a couple of impairments that they had. So they saw an impairment of intangible assets with Sun Art, as well as an impairment of goodwill with Youku. So both of these kind of affect that GAAP EPS number. So non-GAAP EPS for this quarter is probably a little bit more accurate when you take those numbers out. And that would help their earnings a lot, because when you look at their GAAP EPS numbers over the course of the last last few years, we can see that 80 cents for the fourth quarter is a very low number. A year ago, they put up closer to that non-GAAP number of $2.60. And then if we go back a few years, we could see it was $1.18. And then they had this amazing quarter of $4.42. So they consistently deliver very high numbers in the fourth quarter. So it's a little bit concerning that it's low. But again, I think a lot of that comes from the fact that they had these impairments. Here they have their revenue numbers broken out by segments. And it's very interesting to look at some of these because their main largest segment, which is Taobao and Tmall, really had no growth at all. So customer management grew 0% year over year, direct sales and other grew 2% year over year. However, Chinese commerce wholesale, which oftentimes mean that they're selling bulk products to the US and US businesses, grew by 23%. So overall, that shows a rebound of customers looking at China and getting their products out of China. That's a good thing because it shows again also that the slowdown in the economy around the rest of the world has kind of fallen to the wayside, and we're starting to see a little bit of a pickup there, as well as China being able to export a lot of these goods. With a lot of their ports being shut down over the course of the last 4 to 5 years, that has been a concern. However, we're seeing that kind of turn around here with this number of 23%. Wholesale is a very small portion of their business, so it didn't contribute much to their overall growth number. And cloud also went through something similar. They had only 3% growth year over year. In my opinion, China kind of lags behind the US in terms of technology. So cloud for Alibaba is going to be a bigger growth vector over the next 5 to maybe 7 years. I think right now, having slow growth isn't really a concern because they're still the number one player in the market. It's not like someone is stealing market share from them and they have this slow amount of growth. The market in total in China is growing at a very slow pace just because their technology lags behind the US. Part of the reason why I'm glad Alibaba didn't spin off all these other businesses is because they're higher growth businesses. We can see that international commerce retail grew 56% year over year, wholesale grew 8% in this section, and overall that allowed this business to grow 44% year over year. Their logistics business also grew 24% year over year, their local services group grew 13% year over year, and digital media and entertainment grew 18% year over year. With slower growth on Alibaba's top line numbers, one of the ways the management team is trying to return value to shareholders is by repurchasing the stock. In the last quarter, Alibaba repurchased $2.9 billion worth of stock for a total for 2023 of $9.5 billion of repurchases. This reduced their outstanding shares by about 3.3% throughout the course of the year. And on top of all of this, the board of directors approved an increase of $25 billion to the share repurchase program. This means that Alibaba could repurchase $35.3 billion worth of shares over the course of the next 3 years. To put that in perspective, Alibaba's market cap is currently sitting at $193.2 billion. That means with $35.3 billion of repurchases, they could repurchase about 18% of the total market cap of the company. And obviously that is based on the current stock price, but ultimately what this means is we could see Alibaba's earnings per share increase by 10 to 20% over the course of the next 3 years just from repurchases alone. The last time we saw Alibaba with this low of amount of shares outstanding was back in 2015. So it's good to see the company reversing their trend from increasing their shares outstanding to now decreasing their shares outstanding. And ultimately, this is a great thing for investors because what it means is that you as an investor own more of the profits that Alibaba is producing. So my personal thesis around Alibaba is that they are going to see a big turnaround on their earnings per share as well as their top line growth. I think is going to accelerate over the next 3 to 5 years. This is mainly going to be driven by 2 factors. One, China adopting more cloud technology. With Alibaba being the front runner in this industry, this will have a massive impact on their numbers. But 2, China right now is in an economic recession. And if we see them turn this around and come out of this, we should see Alibaba benefit from this greatly. And right now, expectations around Alibaba are at a very low point. We can see for the current year of 2024, analysts have an EPS estimate of $8.74, and they have this barely growing in 2025 to $8.81. And right now, you're getting Alibaba at a dirt cheap valuation. The forward P ratio is sitting at an 8.24. In my opinion, Alibaba should easily be trading at a 15 15, if not a 20 to 25 forward PE ratio. And ultimately, that could result in a 2 to 3x in the stock price if their valuation were to shoot up to those numbers. However, do not buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. So with all of that said, I hope you enjoyed the video. If you did, drop a like down below. And if you want to see more videos like this one, make sure to subscribe. And as always, guys, have a wonderful rest of your day.